Today, I'll be sharing about the collapse of Signature Bank. Before we dive into what caused the collapse of Signature Bank, allow me to share a brief introduction to the start of Signature Bank. Signature Bank started as a commercial bank in 2021. It provided services such as commercial real estate lending, providing loans for property development and investment. It was also involved in fund and venture banking, catering to private equity, venture capital, and hedge funds with specialized banking services. Most notably, in 2018, the bank started being involved in the cryptocurrency sector, offering services to crypto companies and operating a SingNet, a proprietary payment network facilitating real-time blockchain-based fund transfers. Interestingly, Signature Bank decided to open in the early 2000s, which presented a challenging macroeconomic landscape in the US banking sector. We had the dot-com bubble burst, the collapse of numerous internet-based companies in 2000, which led to significant market downturns affecting investor confidence and economic growth, the recession where the US economy officially entered recession in March 2021, the September 11 attacks where it further destabilized the economy, leading to increased market volatility and uncertainty. Furthermore, in response to the economic downturn, the Federal Reserve implemented a series of interest rate cuts to stimulate economic activities. Despite these challenges, Signature Bank identified an opportunity to cater to undeserved middle market businesses and high net worth individuals seeking personalized banking services. Signature Bank was founded in 2001 by three former senior executives of our National Bank of New York, Joseph DePaulo, Scott A. Shea, and John Taberlin. Their collective experience at Republic National Bank of New York significantly influenced the bank's strategic direction and operational philosophy. This founder had long-standing relationships with New York clients, especially certain law firms and high net worth individuals. After HSBC's acquisition, many clients felt undeserved by the larger, more impersonal institution, creating an opportunity for a more personalized banking experience. This approach led to the success of the bank's growth. While Signature Bank does not have a formal publicly declared mission and vision statement, its core values and operational strategies reflect a commitment to serving privately owned businesses, their owners, and senior managers, demonstrating a focus on personalized services and building strong client relationships. Next up, the more interesting portion of today's sharing, the fall of Signature Bank. Here's a quick timeline overview of what happened. We'll be diving in depth to the events later on. Moving on, the primary risk driver that drove the closure of Signature Bank was liquidity risk. Signature SBNY was firstly over-reliant on uninsured deposits, as over 90% of their total deposits in 2022 were uninsured deposits. Why did they have so much uninsured deposits? As they focused on private client banking for high net worth individuals, law firms, venture capital firms, and crypto firms. Clients also routinely held deposits well over the $250,000 FDIC insurance limit. Though uninsured deposits allow for faster growth, but made deposits more risky and unstable during times of uncertainties. The rapid growth from 2017 to 2021 amplified liquid risk too. Why and how? The rapid growth was fueled by concentrated deposits from crypto firms and private equity or venture capital funds, where clients often held millions and to hundreds of millions in deposits. When it comes to liquidity stress testing, the bank failed to accurately model scenarios where large clients would pool funds simultaneously, showing the bank was unprepared. Another reason that led to the failure of Signature Bank was management failure. Let's take a look at Signature Bank's management response to a series of events that led to their failure. During the period of rapid growth from 2017 to 2021, SBNY's focus was to pursue growth aggressively by emphasizing deposit accumulation from large institution clients, and their risk appetite increased too. While their risk appetite increased, they failed to scale risk management functions proportionally and rejected examiners' concerns about deposit concentration and over-reliance on uninsured funds. The next management failure occurred from 2019 to 2022. Despite FDIC's repeated flagging SBNY for inadequate liquidity stress testing, weak contingency planning, and high crypto and uninsured deposit concentrations, the bank responded with minimal actions such as delivering check-the-box compliant actions without addressing root issues. Rather than reducing exposure, they increased crypto deposit threshold instead. More importantly, SB downplayed liquidity risk and resisted FDIC exam escalation. Soon after, the 2022 crypto market crash happened when big players like FTX and Terra began collapsing. Public and regulatory scrutiny of crypto banking links intensified too. SB responded by issuing press statements claiming they were not a crypto bank, while internally maintaining high exposure. They also pledged to reduce crypto-related deposits by 8 to 10 billion, which was a reactive, not a strategic move, while continuing to claim financial strength and dismiss FDIC's growing concerns. From January to March 2023, peer financial institutions like Silvergate and SVB started coming under pressure due to macroeconomic shifts, sector-specific vulnerabilities, and flawed risk management strategies. Then, the management responded by issuing more press releases, emphasizing strong liquidity, capital, and low crypto lending exposure. On March 10, hours after SVB's failure, Signature's presidents had dismissed FDIC's concern about deposit flight as overstated. Internally, they misreported liquidity, listing pledged securities as unencumbered, exaggerating availability funding. The bank response to supervisory concern was not timely, effective, or comprehensive. Finally, on March 12, 2023, after a 20% deposit run in one day, the New York State Department of Financial Services seized the bank. The management was unable to access sufficient emergency funding and failed to provide regulators with accurate real-time liquidity status during its March 2023 crisis because of multiple interrelated operational and governance failures. SBNY also had no functioning liquidity contingency planning despite previous warnings. Here's a quick summary of the failure of the bank's management. A series of risk oversight repeatedly minimized or ignored FDIC's examiner's warning, downplaying risk publicly while raising internal crypto threshold, failing to model realistic withdrawal scenarios or prepare emergency plans, issuing overly confident statements as stress mounted, and no functional plan or collateral available at time of deposit run were part of all the causes that led to the failure of the bank. Lastly, here are some key events that happened after SBNY closure. FDIC was soon appointed as receiver and created as Signature Bank NA. All depositors were guaranteed full access to their funds, and most of Signature's bank's deposits and some loan portfolios were acquired by Flagstar. After the failure of multiple banks, the Bank Term Funding Program (BTFP) was launched by the Fed to offer bank loans and against treasury securities. And thank you for your time.